You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast, where our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is real estate investment expert, Mike Zlotnik. Now, Mike has been a debt and equity investor in the real estate world for more than 20 years. He started his career, had spent nearly 15 years in the information technology field managing risk, business intelligence, and quality of complex systems, software, and processes. While building a successful career in IT, Mike's passion has always been real estate investing because of its predictability of outcome as well as understood risk. Now, Mike currently holds the title of CEO at TF Management Group, and under Mike's leadership, the company has seen transformational growth, delivering strong returns for their fund investors. Now, Mike holds a bachelor's degree in mathematics from Binghamton University. Mike is also a member of multiple real estate and investor mastermind groups such as Collective Genius, Freedom Founders, and Venture Alliance in California. Now, and so, guys, I'm excited to have Mike here to the show. So, Mike, welcome to the show here today. How you doing, buddy?
Thank you, Kevin, for having me. I'm humbled and honored to be on the show, and I appreciate the warm introduction.
Yeah, excited to have you here as well. And as we had figured out here in the beginning that we were both part of a similar mastermind here out of the Tampa Bay area, probably a group of the most successful, for the most part, residential wholesalers and fixers and flippers here in the country. And you and I were probably some of the oddballs in the group, with being that we're in commercial real estate, but phenomenal group, great group of guys there, and some incredibly heavy hitters as well. But with that, Mike, what I'd love to do is in the beginning here of the show, for those folks that aren't familiar with you, your background, take a few minutes, tell us a little more about yourself, what it is you do in the real estate space, and ultimately how you got started.
Sure. So first of all, again, I appreciate being on the podcast. I come from Russia with love, as James Bond. Not quite. I actually grew up in the former Soviet Union, Republic of Moldova. I left the country in '89, just to be clear. I've lived in the United States much longer than I've lived there. I'm a U.S. citizen and a U.S. patriot. I live in Brooklyn, New York. Family, lovely wife of 21 years, 4 kids and a cat, the 5th child. And those of you who have pets can appreciate that. Real estate is my passion. As in the intro, I discovered that this is what I'm good at, this is what makes me money, and this is what I really like. And I jumped into real estate in 2000 and have been kind of a journey ever since, and a full-time fund manager since 2009. So we invest in broad range of real estate projects all over the country, kind of diversify across many regions, sectors, strategies, and for a mathematician, a professional mathematician, it's all about projects, returns, and doing it with the right people. So I've enjoyed this journey for many years, and that's what I do. I mean, that's kind of what it's both business and fun, and I don't know what else to say. That's
fair enough.
And people call me Big Russian or Big Mike, right? It's I don't know, because I grew up over there, but I'm a big dude.
Where's the big part? You're sitting down, so I can't really gather context of. Are you like 6'5"?
I'm 6'4".
Okay,
and on a heavy side, so I'm big. I'm a little bit of a big guy, but
awesome. Well, I appreciate that background, and just to get some clarity, TF Management Group. Are you guys? You have multiple funds that you have operating at any one given time. Are you investing in your own projects? Or are you investing with other sponsors, or a little bit of all the above?
So all of the above. Mostly we are funds or funds. Every one of our funds is essentially mostly LP, sometimes co-GP type of investor. We have a Tempo Growth Fund that invests in growth strategy. We have Tempo Opportunity Fund that invests in income and growth strategy. Mm-hmm. And we're launching Tempo Income Fund that is purely income strategy. So do we do our own deals? Absolutely. We do a lot of hard money loans. We finance a lot of fix and flip deals. So from that perspective, we are originate and we do our own deals. At the same time, we invest with plenty of operators, sponsors into one-off deals and other funds.
Mm-hmm.
So it's a fund-of-funds strategy kind of an aggregate.
Got it. Are these funds that you're operating closed-end funds, or are they evergreen?
Both. So we have Tempo Growth Fund is a closed-ended classic real estate fund, and a Tempo Opportunity Fund is an open-ended evergreen fund.
Give me the comparison of the two. What type of assets are in each one of those, and ultimately why one closed-ended and the other one open-ended?
So we started with an open-ended fund. The strengths of the open-ended fund, you can keep raising capital on periodic basis quarterly, and you can keep making investments and reinvest capital that comes back from files. It's got its positive. One of the major negatives with any open-ended fund is mark-to-market on quarterly basis. So however often you raise capital, you have to be able, because you sell additional units or you redeem existing investors. You got to be able to value the portfolio, call it mark-to-market concept. So that's one of the challenges of this fund. So we launched this fund. We got it to a pretty good size. We'll continue to invest in both income and growth projects. But once we launched Tempo Growth Fund, we've been purposely focusing a little bit more on income on the Tempo Opportunity side and less on growth, and then shifting virtually all growth projects into Tempo Growth Fund so that that fund can exercise its primary purpose, invest into value-add projects for growth. So that's kind of been the journey. One thing I can tell you that when you mix growth and income strategies, the growth projects create tax efficiency, as you know, a ton of tax efficiency. And it creates actually yield drag on the income projects. So mixing growth and income projects in the same fund has a little bit of that extra tax efficiency, a little bit yield drag on the distributions as the result. As a result of learning that, we decided to spin out yet a third fund called Tempo Income Fund to avoid the yield drag and purely focus on income strategy. And that, generally speaking, people can do their own mix. Hey, I want 40% in growth and 60% in income. Go pick which funds you want and to what degree.
Give me an example, just so again, some added context. An example of an opportunity, an asset that's in this most recent third fund, and why it ended up there versus maybe just pick an opportunity that's in one of the other two funds, and just give us an explanation of why it went into this fund and why the other went into the other fund.
Sure. So I'll give you some simple examples. So Tempo Growth Fund, this is the closed-ended fund, classic real estate. We started in January 2020, and then we really accelerated kind of as pandemic hit. Ton of opportunities came to table, and we've been focusing on a few of these strategies, specifically hotel conversions to multifamily. Right? That trend has been pre-COVID idea, but it definitely accelerated and increased in the opportunity size and the opportunity returns during COVID. So we've been investing. We have 6 investments in that strategy. What's interesting is Tempo Opportunity Fund, which is our open-ended fund, did have one deal in that sector pre-COVID, and they just went full life cycle and showed us the massive potential. So we did one investment in May 2019, and 21 months later, in February 2021, it exited with an IRR of over 73%. It was just a home run.
Wow.
And so the idea was pre-COVID, but now it's kind of gotten an accelerated boost in the last year, and that's what we've been doing. Quite a bit of these deals. So I'll give you an example. We did 2 deals, 2 conversions of residents in extended stay hotel to essentially affordable multifamily housing. One in Winston-Salem, the other one in South Bend, Indiana. So the strategy is very straightforward, makes a ton of sense. The reason we put it in the growth fund is when you're converting a hotel, you have a redevelopment exercise. Even though it's not super heavy lifting, taking an extended stay hotel into multifamily, it's still redevelopment. So it fits the fund strategy. So that's kind of number of recent deals been going in the Tempo Growth Fund. In the Tempo Opportunity Fund, I'll give you some examples of a few recent deals. So we work our whole investing strategy is based on the relationships. You mentioned some of the masterminds, including the Collective Genius. I've met a ton of the best guys in the country called the movers and shakers. That's what they call them. The sharpest cats. And we have these relationships for many, 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 many years. depending on where the person is and their strategy, we'll invest with them. You're going to ask me where the hell we invest in. We invest where the people are. Yeah. So I'll give you an example. We have one guy in Northern California. We've been investing with them for many years. His whole family invested in our funds. In the last few years, he's built substantial expertise buying land, getting it permitted for cultivation of cannabis, and basically selling it. It's a strategy. It's a land play, and the whole value add in the land is getting it permitted for cultivation. That's all it is. So we've been doing loans to him, hard money rates, 12 and 3, for example, but he gives us an equity kicker. So the point is, it works really well as an income strategy. We'll take the equity kicker. It's always, what's really interesting, the equity kicker could be worth a whole lot more than the interest.
Sure.
But you're still counting, worst case scenario, you got your interest. So it's one of the recent deals we did. We just did a deal with a couple of guys also in CG Mastermind that buy land for cash, 3, 4, 5,000 a lot in the middle of boonies, and then they sell them on seller financing, discountlots.com. So they basically sell it 6 times the price they pay for $18,000 on a credit card paid over 6 years.
Oh my gosh.
Right? Returns are crazy. We're financing them. We basically have an equivalent of a hard money loan secured by that portfolio of these lots. The beauty about this, they sell it on a land contract. They don't transfer the title until they're paid in full. Because you don't want to foreclose on a $3,000 or $4,000 lot. You know, they don't pay, well,
your legal fees.
yeah. They just get kicked out. It's almost like a lease with an, rent to own. So we've done those deals. We continue to do industrial deals. So recently we invested in a triple net industrial warehouse, distribution warehouse in Murfreesboro, Tennessee. That's an income deal. So we basically look at what fits where. Is this the right strategy, the right sponsor? We're very opportunistic and dynamic. We don't have a set. The PPMs are written extremely broadly, giving us full power to shift as opportunities shift.
Got it. I love it. So I want to hit on the hotels. I know we talked about this a little bit before we started recording here today. The hotel conversions. That is incredibly intriguing. It's surely not a well-known skill set. I mean, you don't see folks talking about that left and right as far as converting hotels into multifamily projects. And again, given the last year of dealing with COVID and the pandemic, I mean, of the many industries that got hit fairly hard, I'd say hospitality probably ranks as number one as far as just take an absolute beating. And as you'd mentioned, it was an idea pre-COVID. It was already kind of in the works. However, COVID pretty much accelerated it and ultimately flushed out opportunities that might not have presented themselves otherwise. And so I'd love to get a little more granular into this hotel to multifamily conversion. I don't know how much intimate knowledge you have as far as the mechanics behind it, what makes a good opportunity and what doesn't. But please just point me in the right direction as far as, I guess, first and foremost, like what, aside from the market, right? The market's everything. Can't change the market. So ultimately you want to be in the right market that has a demand for affordable housing. And assuming that we've already got that one figured out, looking at the actual structure itself, what makes for a good conversion versus a building or a hotel that doesn't make for a very good conversion? I'm sure that there's some that are great and some that just run away as fast as possible. Can you give some insights?
Sure. So number one, extended stay hotels, they are number one candidate because they ease a conversion. So extended stay hotels are typically your residence in number of these inns that the rooms look like mini apartments. Yeah. They have kitchenettes installed. They have a bedroom and a living room of some sorts. So from a product perspective, that's a more attractive because it's got lower redevelopment cost. From a location perspective, you want to have a hotel that sits pretty much within the residential neighborhood, maybe on the outskirts of residential neighborhood, but the area itself is naturally fitting for yet another apartment complex. So you want to fit in. What you don't want to do is pick a hotel off the highway in the middle of nowhere. Yeah. Right? That's definitely a negative. But on the positive side, you're looking at natural fit zoning. So zoning, ideal zoning is when a hotel naturally has a zoning for multifamily. If you have that, that's a perfect setup. The alternative becomes it fits in, but it may require an approval request to a zoning board. So it becomes an exploratory conversation. Can you submit a request? Does the city want another multifamily complex there? If the city does, perfect. From the affordability perspective, obviously feasibility study needs to take place. Does this location with this type of units, with this type of rent, does it fit in, and how much demand there is versus the supply, right? If you can determine that, 80 to 90% of these extended stay hotels in good areas, they're already naturally good candidates. It would be cheaper to convert than to build from scratch. Mm-hmm. If you can talk with the local government and get a general, we love the idea, and most cities and towns welcome the idea because they're short on affordable housing and they don't need another dysfunctional hotel that's just not doing much business during the COVID. And what's really fascinating is the good candidates didn't even do good business before COVID. So they were sort of very weak, and the COVID just knocked them out. So from that perspective, finding those projects can make good basic economic sense. What else?
How many doors are typically in one of those residence inns? Is it 80 or 100? Is it somewhere in that range?
Yeah, exactly. So the optimal size, at least the few projects we invested in, is that 80 to 120. So we did two. One is 88 doors. The other one is 80. It's exactly almost like hit it right in the nose. You can go a little higher, but you're not looking at a high rise. You're looking at a spread 2-3 story hotels, generally speaking, that naturally look like apartments anyway.
Yeah, interesting. And I'm assuming that these ultimately are going to be one bedroom or studio type of units. And so the demographic, not just the market, but that specific submarket's got to support that particular type of demographic, someone that's seeking, there's demand for a one bedroom or a studio type of unit, correct?
Yeah, exactly. We did another project in downtown Mesa, Arizona. That's an old Ramada Inn conversion to multifamily. And let's just call it flavor 2 of the ice cream. The flavor 1 is your extended stay. The flavor 2 are your Ramadas. They look like a motel. What's their product is the studio. And they can work very well for students who seek housing. That particular hotel is right next to the light rail train stop, which connects to a bunch of colleges. So students would enjoy privacy of that room and off-campus, less expensive product, right? So that's a natural fit. 2, just general workforce housing. Mesa, Arizona is a kind of, got to be careful now with all the politics, blue-collar workforce neighborhood. You have more affordability concerns there than if you went into one of the nice areas in Phoenix. So as long as you get into that natural fit where affordability is the key, it works really well. Single person who wants their privacy, maybe a couple. This is not for a big family, but it's privacy, well, located, less expensive than if they had to rent one bedroom, and it would be a renovated product. And it should compare fairly well and fit into the overall rental market in that area.
I'm assuming it's probably not cost effective to ultimately put in individual meters for like water or electricity, right? I mean, these are probably all inclusive rents. It includes water, sewer, trash, electricity. Is that typically how these are formatted?
It depends. I would say yes for some of these hotels, like Ramada conversion. For some other ones, it's possible to have a separate meter, maybe separate electric meter, probably water, and then the HVAC. It really depends on the setup, right? If you have your own air conditioner in the window, well, it's plugged into the apartment. If it's central air, maybe there's a fee for that.
Gotcha. Very, very interesting. Have you gone full cycle with one of these projects yet?
Yeah, that's the only one we've gone full cycle is the one hotel in Ogden, Utah. That was a boutique hotel. That was not your extended stay. It was a boutique high-riser that got converted into nice apartments. Okay. So that went full cycle. As I said, we basically got 2.2x in 21 months, generating IRR of around 73%. That's the only thing we've got full cycle. What we do know today, there is a rumor, for example, this Mesa, Arizona property, all in cost roughly $11 million, with a target pro forma sale of around 15 on a 5-year hold. It's leveraged about 60% debt, 40% equity. So it's about double. It's 2x multiple in 5 years. Nothing crazy, but it's a very conservative underwriting. There's a rumor or a whisper that there are interested parties today to pay a whole lot more than 15 already very early in the project, right? We don't know that for sure, but anecdotal evidence we have is that these hotels can outperform the projections by quite a bit. With a full disclaimer, a lot of uncertainty, a lot of risk.
Sure. Is Fannie or Freddie, is that an option once these get stabilized and completely converted into multifamily? Will they step into that space?
Yes, it's a refi of a multifamily, stabilized multifamily. So most of these projects, from a project plan perspective, you typically running at a refi point around 18 months into the project. Why 18 months? Because you need enough time to convert, stabilize. You can actually do it if things go reasonably well. Within 18 months, you can essentially fully convert, fully stabilize, and then refi, get good amount of cash out of it.
Very interesting. So what does your crystal ball show you, Mike, here in the coming, call it 12 to 24 months, as far as additional fallout in the hospitality world, right? I think that we're still in this weird, hamster wheel phase where, nothing bad is ultimately really pushed out of this pandemic just yet. At least I think there's going to be some messiness on the other side. Do you see a lot of opportunities coming to the surface in the hospitality space here over the coming years?
Sure. So because you asked me about the crystal ball, I have to use my explanation on the crystal ball. It's one of my favorite expressions. I used to have a wonderful crystal ball, but it broke, and I can't find another one for sale. If you know one, I'll be happy to buy it. It's what we see is that in the commercial space, obviously due to some of the foreclosure slowdown, not necessarily moratorium, but it's been more difficult to foreclose, and banks have been careful and slower to foreclose. I feel there is still a good amount of distressed product out there. It's just not being aggressively pushed out. So to get into quality deal flow, it's a whole science how to obtain the good deal flow. So what does it mean? If you can get to specialty banks, if you have relationships and you can buy distressed paper from them, right? That's an opportunity to buy it and then try to foreclose or try to work it out with the owner. The alternative to that would be try to get the product on the market. So the product on the market is could be badly overpriced. Like anything else, you want to see motivation. So motivation means it's operating hopefully at a bleeding point, and then the bank is somewhat motivated. But finding these super high quality deals at a great price is not easy. It's not necessarily you could go buy a whole bunch of them.
Yeah.
It's marketing work to find the quality product.
I'm just wondering in the hospitality space. I mean, there's still many parts of this country. I mean, your hotels, maybe they're back to 20% of pre-COVID numbers. And I know that there's plenty of buyers in the hospitality industry that are ultimately probably waiting with some dry powder that would like to scoop up some distressed opportunities. But I still feel that there's probably a lot of cold feet as well, as far as, just not knowing when certain areas are going to really see a comeback, especially with like business travel and things of that nature. You've got, company-wide restrictions. I mean, my wife, for example, works for a very large a software company. And ultimately, up until literally like a week ago, they weren't allowing their salespeople to travel. And I think that's pretty true across the board as far as some larger institutions, larger companies. I mean, they're keeping their salespeople at home, and those are the folks that would typically use those extended stay type of hotels, traveling for work or, sales meetings or what have you. And so in any event, I'm just, I watched the Trump report, and you're just really following what's going on in the CMBS world, and I think there's some stress cracks that are showing, and ultimately I think that there will be some fallout here coming down the road. But you're right, I don't know exactly how it's going to show itself, but I feel it's inevitable that there's going to be fallout as a result of what we just went through here for the past year. But then again, I'm not an economist, and I don't have a crystal ball at work, so just making assumptions.
Well, let me add just a couple more comments on this. So the downtown hotels are definitely suffering, right? I mean, you're talking about the hotels that catered primarily to the business travelers.
Yeah.
And will they continue to suffer? Probably for extended period of time. you got a couple of issues. One is the corporate restriction on travel. Two, even if restrictions are waived and limited, a lot of virtual business will be it has become the norm. Let me put it this way. So you probably have recovery demand, but the demand not to the same level as pre-COVID, number one. Number two, location, right? If you have seasonal hotels, seasonal, let's just call them vacation rentals, the market seems to be recovering. People have been locked up for a long time, and the demand for those have picked up quite a bit. People are trying to get away from the big cities, right? So that's not a good product from the acquisition to convert standpoint. From acquisition of a hotel, buy and hold until the better time comes back, you have to be really a specialty player. It's not what we do. It takes specialty expertise. It takes the right balance sheet, right? So I would say that you're really looking for kind of the path of least resistance. Is there a difficult hotel today? Is there a distressed seller who is bleeding? And that's what you're looking for this strategy. Can you pick up discounted hotels and just carry them forward? Absolutely, you can. If you have enough capital that's patient enough, can sit when weather through. We don't know whether there's going to be mutation of COVID. There will be 2.0 of COVID.
Yeah.
There's going to be some new vaccine, and it's going to continue on and on and on. This could continue for quite a long time.
Yeah, no, I agree. And so, speaking to that, over this past year, have you changed any of your investing activities or strategy as it relates to COVID? And I guess you could say post-COVID. Has anything majorly been changed or modified within your business?
Well, conversions, right? So we talked about the hotel conversions. That's a substantial shift into the opportunity. The other thing, the other opportunity where we see is office conversions to multifamily. We do have one investment. It's an office building right next to the St. Louis Cardinals ballpark. So it's being converted to multifamily, kind of nice, high end, with the rooftop views of the game. So you can pick up the right office buildings that have ton of vacant space, and they're no longer ideal candidates for office, but they're better candidates for multifamily living, right? So we did a little bit of that. On the financing of fix and flips, it's a little different. One of the big challenges you mentioned earlier, I don't know if you mentioned, or at least I had another call earlier today, the residential market is on fire, right? The residential market, kind of all the properties all over the country, they're just through the roof. And we're just trying to be more careful now. We'll be financing some of these fix and flip projects. In my view, most of the markets have gone too much, too fast. And they've been heavily supported by lack of supply. At some point, the supply will come back into market. Interest rates are rising. Affordability is getting worse by day, literally, with these escalating prices. So I would be a little bit more careful now. Even though the trend is your friend. What I don't want to do is over speculate that'll continue indefinitely. After such a good run, there has to be some sensitivity to what's happening in the economy, but the government is dumping ton of cash. That's what's happening. The money is many dollars chasing fewer deals. That's your classic inflation. $10, 10 apples, it's $1 an apple. When you go throw in another $10 in the economy, you still have 10 apples. People are paying $2 an apple. So that's the problem.
I like that comparison. So with the fix and flip stuff, being that's a moving target in the residential space. I mean, I just Denver. I saw some article that got posted that in the last month, home prices, the average home price increased by 10% in Denver. That's mind-boggling.
Unsustainable, right?
How do you how do you in the typical hard money sense, when you're actually lending to a fixer and flipper that's maybe got a an estimated 2 to 4 month turnaround time, they've got their estimated after repaired value, but that is such a moving target today. I mean, do you just drop a lower LTV in there as far as what you're willing to lend, or man, that's interesting times to deal with for sure.
Well, the trend is our friend now. If it continues to increase in the value, as long as we use current comps, the primary issue is that the folks that get aggressive, it's hard to buy the product at the right price. So they're assuming 6 months down the road, the price will escalate another, say, 10%. That's an aggressive assumption. I mean, 10% a month is crazy. it's even 6%, 10% in 6 months is also pretty aggressive.
Yeah.
So for us, we're just trying to be more conservative and work with the guys who are willing to take a little bit less risk. But it's spring and summer. The outlook is still pretty decent. But we don't know what's going to be the next Black Swan event. And one thing I can tell you that when things are running extremely well everywhere, that's the time to be extra careful, for the reason that until there is when these Black Swan events happen, they happen fast and hard. So you got to hedge. You really have to hedge today and diversify.
Agreed. So I want to switch gears real quick before we end the show here, Mike. And I find that most people always love it's real exciting talking about all the good deals that you've done over the years, the ones that had the highest returns, exceeded expectations, what have you. But very few times do we really dive into the bad deals, the ones that lost sleep over, lost hair over, most amount of stress, what have you, lost money, what have you. And so, can you think of a deal? What comes to mind when I say that? What comes to mind? And if you would, please share some details as to what the deal was, what ultimately went wrong, and what you'd have done differently the second time around.
Sure. So when one deal comes to mind, it hasn't gone full life cycle yet, but we know the outcome. We're barely going to make any money after futzing around for 4 years. It's a deal with a competent sponsor that was somehow poorly executed. Even though we've done 10 deals not 10 deals, but number of deals with that sponsor. Most of them have gone well. This one has had difficulty. It's Chicago market. It's overrun the construction cost by a lot. The overran the time by quite a bit. And for some miraculously bad reason, the rents post-renovation were not even close to the pro forma. So the sponsor overran the budget, overran the time, and was not able to achieve target rents post-renovation. And 4 years later, it looks like, we're going to get our money back, maybe a couple of dollars over. Unfortunately, deal like this is not fun. Now, it's not the worst deal that we've been through, but this is an example of a situation where you have a competent sponsor in theory, good deal on paper, but it doesn't always go that way. Yeah. Give you another example. We have multiple deals, right? You remember the bad deals. You don't remember the good deals. It's funny how it is. You just remember the ones that like you said, you lose some sleep over.
Yeah.
We have another deal in Houston, Texas, ground up self-storage, and the market got oversaturated. Similar issues, construction problems, GC filed for bankruptcy. It was stuck in litigation for a good amount of time, overrun the budget, overrun the time. And on the lease up, we're not achieving the target rents. So what happens with that? You get after 4 or 5 years of futzing around, you get barely a small positive return. It can happen. I mean, this is not catastrophic loss of capital, which is worse, but at least you're recovering your principal. But you put your money out for 4 or 5 years, you're not getting much of a return for that. So these type of scenarios can happen. And self-storage is actually brutally competitive. If you got a couple new facilities open in your 3-4 mile radius, you got a problem. So you got to be prepared for overconstruction. And sectors and industries and cities and towns can be oversaturated at some point. And when it happens, all your rosy projections could not materialize.
So with that self-storage deal, you said you've been into that project about 4 or 5 years. Is that correct?
Yeah, we invested in right around 4 years ago, almost on the nose.
So ultimately, I mean, what really occurred there? You said the GC got caught up in litigation. So did that just halt the project for a number of years while other competitors came in and built new products? Because obviously self-storage goes up fairly quickly in comparison to multifamily and pretty much any other asset class. They get erected.
Right. There were substantial delays with constructions, substantial budget overruns. The operating partner on the ground completely failed. It had to be taken by another partner. The property had the litigation by the GC. Now, additional capital was brought. The property was finished and brought on the market, but the lease up speed, absorption rate, as well as the target rents were not kind of hitting the pro forma. So combination of those things together, all of them, what happened? Again, what I don't want to do is focus on necessarily negative projects, but you remember them. For everyone like this, we got a bunch of really good ones. Unfortunately,
there's lessons learned. I mean, things don't always go right. I mean, I think that's generally speaking, that is the world of real estate. I mean, if you're going to be in the real estate investment space, don't come into this expecting that every deal is going to go exactly as planned. Some are going to actually exceed expectations. The other ones are not going to meet expectations. So it's just, I think it's the nature of the beast. You know, I know you're a mathematician, so like you've probably got a little bit more of a calculated approach, right? But generally speaking, though, even being a mathematician, it's not 100% every time.
Yeah, what I do is we basically apply loss reserves every project. Mathematically, if your pro forma says 20, and this is a speculative project, you have to water it down by, say, 6%. So your target IRR comes down quite a bit because it's risky. And it's not necessarily that one project can underperform, but if you take 100 of them mathematically, right, it is inevitable something will go wrong.
Sure.
Right, you have to risk adjust for the ones that'll do bad. The other really important thing to consider, that if you are diversifying among a single strategy, sometimes the strategy gets hit. I mean, like COVID hit hospitality.
Yeah.
So you have to be kind of very mindful what you invest in, and can you withstand exposure to one strategy, one location, something going bad, one operator going bad, or maybe even a few of them. And that's why investing in a diversified fund works.
Yeah.
On average, we do well. But if you were asking me, hey, how is this deal going or that deal going? We have a few kind of difficult files in the portfolio, and we have some home runs. And what happens on average, you wind up getting investors that target return in the low to mid teens. Yeah. But if you just put your money in 2, 3, 4, 5 projects, and 2 of them went bad, unfortunately, you could take it on the nose.
Yeah, no, absolutely. Now, I know we hit on multifamily and self-storage, but have you guys dabbled in any other asset classes? I mean, true hotels, or not hotels, but office, not hotels, but office, retail. I know you mentioned industrial. You hit on that one, but any of the other asset classes that have been attractive to you, or have you spent time in the past?
For sure. So we have a number of office projects, and those are generally doing pretty well. They were not heavily impacted by COVID. Mm-hmm. We did have, in Tampa Opportunity Fund, off the top of my head, 5 or 6 shopping plazas. Most of them were shopping, basically not enclosed malls, but shopping plazas. And originally, we were very nervous about it. Today, they are virtually all of them except one are back to normal. They've recovered quite a bit. What else? You meant office, shopping. Again, we were fortunate enough not to invest in the hospitality pre-COVID at all. We had nothing in the portfolio at all in the hospitality. I don't know why, but it just we would have taken advantage of some projects, but it just maybe luck of a draw or something.
I think it's a very different business as well. I mean, it's such an operationally heavy business. It's very different than that of office, retail, industrial. I mean, pretty much any other asset class. It's kind of its own standalone. It's very similar. I compare it to like senior housing, right? Lots of moving parts and just very operationally intensive. And so again, it's more of a business play than it is a real estate play. And so at least that's my opinion.
Oh, Kevin, I agree with you 100%. What's funny is that is as active of a business as you have your senior living. You have half real estate, the other half is operating business. Mm-hmm. You can't disjoin them. The same is true, obviously, for self-storage is somewhat similar.
Yeah,
you have some of the mobile parks are operating businesses, and for sure, hotels are big-time operating businesses.
Yeah, no, absolutely. Well, Mike, this has been a lot of fun here, buddy. I really appreciate you coming on here. What I'd love to do is, before we exit out of the show, I'd like to go into what I call the golden nugget question. I'd simply like to ask you if there was just one final golden nugget of advice or wisdom that you could leave with the listeners here today that might inspire and motivate them as they progress in their very own real estate investing career. Anything that comes to mind?
Yeah, I'm kind of a scholar of marketing. I've read this book a number of times, and I continue to pick up more nuggets. And if you are learning how to raise capital, how to build a personal brand, how to grow, read the book No BS Marketing by Dan Kennedy. It's the ACE, authority, credibility, exclusivity, or expertise. So my nugget is, to me, it's the most valuable thing is you can do is to build your own personal brand. So that's why Big Mike Fund is a personal brand. You're gonna laugh. Back to the history, collective genius, right? Years ago, before I started the podcast, I couldn't figure out how to call it, and the guys told me, the CG guys, hey, call it how it is. You're a Big Mike. And you're a fund manager, so call it Big Mike Fund podcast. So this has become a brand, personal brand, Big
it.
Mike, and that's why there is a BigMikeFund.com is our website, right? Big Mike Fund, easy to remember. If you misspell it, you forget the D at the end. It's BigMikeFund.com. I promise it's not a kinky site.
No, I love that. Dan Kenley's the man. Unfortunately, R.I.P. to Dan. He's no longer with us, but. Absolute brilliant marketing mind and businessman. Just I've read majority of his books. I feel like he came out with more books than I can even keep up with. The guy wrote nonstop, and he's got some incredible material out there. In any event, well, Mike, it's been a lot of fun having you on the show, my friend. Appreciate you coming here. And for those that want to learn more about you and what you got going on, best place to find is at BigMikeFund.com. That's the best place to find you.
Yes, sir. BigMikeFund.com.
Okay, fantastic, my friend. Well, you take care, and happy investing to you.
Thank you. Same to you.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.